Take a moment and look at the timing of this carefully, because the market is no longer waiting for the bell to tell you the story. As of today, spot gold is trading around $5,231.79. PAX-G is hovering near $5,205. Digital gold is still shadowing the broader bullion complex, even as weekend panic has cooled. Spot silver is back near $89.42. The metal is still holding far above the levels where paper traders thought they could contain it. Meanwhile, the real shift is happening in energy. WTI is around $83.08 after a violent reversal from the war-driven spike. The market is reacting to reports that the IEA is considering its largest ever strategic oil release. That detail matters, because it tells you governments are no longer just watching price. They are trying to shape it. So when the Federal Reserve, the White House, and institutions across the system are all recalculating inflation, energy security, and capital flows at the same time, this is no longer just a market update. It is a lesson in how power really moves through the world. First through supply, then through policy, then through price, and that is exactly where the next part of this story begins. Now let's talk about silver, because the metal is starting to reveal something deeper than a normal price move. As of today, silver is trading near $88.89 per ounce in Western spot markets, with recent data showing roughly $88.38 per ounce in global trading. On the surface, that price looks stable, but markets rarely reveal their real story through the headline number alone. Across the Pacific, the physical market continues to behave differently. In hubs like Shanghai and other Asian bullion centers, real buyers have been paying noticeably higher prices for deliverable metal, creating a persistent premium between the paper futures market on COMEX and the physical supply chains moving through Asia. Analysts note that spreads between US and Chinese silver prices can approach $10 per ounce, suggesting the two markets are being driven by different forces. Around 60% of global silver demand is tied to industrial sectors such as electronics and solar technology, placing the metal at the intersection of finance and real economic production. So when silver quietly holds near $88.89 while physical premiums build underneath, you are not just watching a commodity chart, you are watching a market slowly revealing how the global system prices scarcity. And that is where the next layer of the story begins. Now let's step one layer deeper into the mechanics of the silver market. Because the real story is not only price, it is inventory. According to the latest reports from the CME's COMEX warehouses, total silver stocks have fallen sharply over the past months. Inventories dropped to roughly 366 million ounces, down nearly 31% from about 532 million ounces last October. Even more important is the deliverable supply. Registered silver available for futures delivery has slipped below roughly 90 million ounces, a level many traders watch closely because it represents the metal that can actually settle contracts. At the same time, the physical backbone of the global bullion system in London is also tightening. Data from the London Bullion Market Association, LBMA, shows silver held in London vaults declined about 2.4% in February. That leaves roughly 27,065 tons of silver stored across the network, supporting the over-the-counter market. When two of the largest storage hubs in the Western financial system begin losing metal at the same time, the signal is not subtle. Analysts from Kitco and institutional traders tracking CME data say sustained withdrawals suggest rising physical demand beginning to challenge traditional paper pricing mechanisms. And when inventories quietly decline while the market headline still looks calm, history shows the real repricing usually arrives later. Which leads directly to the next question investors should be asking as the system keeps adjusting beneath the surface. Now let's talk about gold for a moment, because this is where the market becomes psychologically interesting. As of today, gold in Western spot markets is holding around the $5,170–5,200 range. Tokenized gold instruments like PAX-G and PXG traded almost perfectly aligned with that level over the weekend. On the surface, that looks quiet, but the world around the market has not been quiet. Over the weekend, we saw energy infrastructure strikes in the Middle East, oil pushing toward $115 per barrel, and geopolitical rhetoric escalating from Washington to Tehran. Under normal circumstances, gold would already be reacting violently to that kind of environment. Yet the metal remained relatively steady. Institutions, from central banks to portfolio managers at firms like BlackRock, understand that gold often moves in phases. First comes the shock, then comes the recognition. Only after that does the price fully adjust, so when gold holds firm while geopolitical tension rises, it is not a signal of indifference. It is often a sign the market is still processing the new reality, and once that realization spreads through global capital flows, the next reaction tends to arrive quickly. Only after that does the price fully adjust. Policymakers at the Federal Reserve, watching inflation expectations and energy prices rise together, are studying the same dynamic. So when gold holds firm while the geopolitical temperature rises, it is not a signal of indifference. It is often a sign that the market is still processing what the new reality actually means, and once that realization spreads through global capital flows, the next reaction tends to arrive quickly. Now let's step away from the charts for a moment and look at the world those charts are trying to price. Over the weekend, US and Israeli forces carried out strikes on Iranian energy infrastructure near Tehran. Massive fires erupted at fuel depots and oil storage facilities, sending black smoke across the capital's skyline. At the same time, the conflict rippled across the Gulf region. Drone and missile exchanges hit ports, tankers, and military facilities from Bahrain to Oman, pushing the battlefield into the arteries of global energy logistics. Energy markets reacted immediately. Oil surged above $115 per barrel as traders priced the risk of instability spreading to the Strait of Hormuz. This narrow corridor carries roughly 20% of the world's oil supply every day. When that choke point faces disruption, even the threat becomes a financial event, and once energy markets begin pricing systemic risk like this, the ripple effects rarely stop at oil alone, which brings us to the next layer of what the financial system is beginning to absorb. Now let's talk about oil, because energy is the transmission channel through which geopolitics reaches everyday life. As of today, crude oil is holding near the $112 to $115 range. Higher oil prices move through the system like electricity through wires. Transportation costs rise. Manufacturing becomes more expensive. Food distribution tightens. Policymakers from the Federal Reserve to energy ministries in South Korea and the European Union are already studying the inflationary implications of a prolonged supply shock. History gives us a reference point. In the 1970s energy crisis, oil shocks reshaped inflation, currencies, and the trajectory of gold and silver for an entire decade. Markets remember that pattern even when people forget it, and once energy begins pushing through the system like this, the consequences rarely remain confined to oil alone. Now step back for a moment and look at the political layer shaping everything we just discussed, because markets do not move in isolation from power. Over the weekend, statements from Washington, Tel Aviv, and Tehran made it clear the situation is not moving toward quick de-escalation. Former US President Donald Trump suggested the conflict could continue for a while. Israeli officials signaled that any new leadership structure inside Iran would remain a strategic target. Iran responded that it is prepared for a prolonged confrontation. None of that language belongs to diplomacy. That language belongs to a system preparing for endurance. Meanwhile, China's Foreign Minister Wang Yi spoke during sessions of the National People's Congress. He emphasized Beijing's readiness to restore stability in the Middle East. For China, this is not abstract diplomacy. Much of its energy supply flows from the Gulf, and Iran remains a key node in the Belt and Road Initiative architecture. So when policymakers, energy ministers, and central banks all begin speaking about the same region at the same time, investors should understand something important. This is no longer just a regional conflict. It is a structural negotiation over the architecture of global power, and when power structures begin to shift, financial markets inevitably follow. Now let's connect the final layer of the picture, because the ripple effects are already moving through the broader financial system. Over the past several days, risk assets have begun reacting to the same geopolitical pressure. Bitcoin has slipped roughly 7 to 8% this week. Ethereum is down close to 9%, erasing tens of billions of dollars in market value. At the same time, major equity indices from the S&P 500 and Nasdaq to the DAX in Europe have shown increased volatility. But one of the most interesting signals is emerging inside the alternative credit market. BlackRock recently limited withdrawals from its $26 billion HPS corporate lending fund after receiving over $1 billion in redemption requests. Similar pressure has appeared across private credit funds managed by firms like Blackstone. These are not panic signals yet, but they are early indicators of tightening liquidity beneath the surface of the system. Historically, shifts like this appear quietly before the broader public notices. Financial cycles rarely announce themselves loudly. They simply begin closing doors one by one. Which brings us to the deeper question investors should now be asking about the next phase of this cycle.